Hello, good morning everyone. Hope you're well. Thank you for taking the time to join our webinar this morning. Your time's much appreciated. I'm Lyndsey, Charnock National Sales Manager, and I'm joined today by our Senior Underwriting Manager, Paul O'Hara, who's going to talk us through our underwriting approach, including an overview of the underwriting team. We'll look at what sets us apart from our competitors, and we'll also touch on a few case studies as well of cases that we've accepted on an exception basis. I know a lot of you have probably had a lot of experience with the world of equity release and underwriting in a lot of the weird and wonderful properties that we come across in equity release. So hopefully you'll find the session really useful. We will have time at the end as well to go through any questions. So please feel free to use the Q&A box at the side and we can pick up questions at the end. Alternatively, if you do want to speak regarding any specific cases, then please feel free to let us know in the chat box again and we can pick up individually this afternoon and go through them. Okay, thank you. So I'll hand over to Paul. And as I said, please feel free to use the Q&A box and we'll pick up later on. Thanks, Paul.
Thank you, Lyndsey. Morning, everyone. Thank you for attending. Agenda really, we're going to go through, as Lyndsey mentioned, we're going to go through our underwriting approach. A little bit of background on the team itself, kind of a few things on what sets us apart, some exception lending case studies, and then, like we said, some Q&A at the end. So, first of all, we like to have our flexible approach as an underwriting team. We allow people to discuss our cases directly with the team. And just quickly, there's some contact details here below, just in case you don't know them already. So I'll give you a couple of seconds if you want to make note of any of them. Mainline number in, and our email address straight into the underwriting team. Okay, so basically the structure of our team so far is myself as head of underwriting. I've been in the industry for over 25 years, experienced in commercial lending, buy-to-let, equity release and residential lending. I have a team of 10 people with me. Majority of the team have been with me now for 5 years to 10 years plus. So we have really good staff retention. No one leaves. They're a really good bunch of team between them. We've got a good number of team members as well, 10, all fully qualified. No one needs to do any referrals. They all have mandate levels to sign off at any level. So yeah, we have a really good team structure and they've been with us for a long time. So what sets us apart? A few things, not everything, but things that we like to look at, but maybe other lenders won't touch. So I know people will look at houses close to commercial elements. However, we do our case assessments by Google Map Review, looking through commentary that's been supplied. So the types of commercials nearby could be anything from a small set of shops to trading estates nearby. We'll take an approach for this type of thing and look outside the box a bit to see if we will lend on it. Another thing we will look at is retentions. We will hold back monies for up to £10,000 for any reports that valuers have highlighted. It could be timber and damp, wiring, party wall in the roof space that needs replacement. As long as the works and estimates supplied are below £10,000, then we're happy to hold that money back and allow up to 6 months for the client to complete the works on completion of the loan. Which we do have flexible approach to that as well, and take into account the customer's needs if any circumstances come up where they struggle to do so. Another thing we like to look at is we allow people who've had not ownership of properties for 6 months of ownership. They might be coming back to the UK from abroad. We don't have specific timescales around when this can be, as long as they have permanent rights to reside and UK residency, then we're quite happy to take that on. Purchase transactions or property they had owned here before and now they want to remortgage back and live in it. We'll consider properties with any number of bedrooms. This type of thing is really for, we don't really mind the size, but it's more of the layout. It needs to be a traditional family dwelling. We don't want it set up as a HMO for letting in future purposes. It needs to be laid out as a correct residential family dwelling, and then we'd be fine with the number of bedrooms. Another point we're flexible on is acreage of land. We'll allow 150 acres of land, 40 acres of land, as long as there's no agricultural use on that land at all, or commercial elements, then we'll charge the whole element, but we're only value up to the 5 acres, the house and 5 acres only. Again, another one with annexes on the land or attached to the security, as long as it's fully self-contained with no internal access. We'll allow Airbnb only on this. We don't want any business registered there or people using it for holiday lets that are registered on websites. Lodger arrangements can just have family or friends living in the annex, just as long as they sign occupancy waivers. That's not an issue. If you do have lodgers that are on ASTs, again, that won't be a problem. They won't need to sign an occupancy waiver. They will just need to supply a copy of the AST agreement, and we'll be totally fine with that. A big one that I know not a lot of people touch, but we'll consider sole applications for married applicants. This could be just for purposes of having the younger borrower on the title and the other person's not. We'll just, if they're residing there, we'll just require an occupancy waiver signed and independent legal advice given. If they're not and they're separated, then we would require a deed of separation. And we wouldn't have a problem with that at all. Overall, the team are very experienced. We have very good knowledge in the conveyancing background. One thing we like to do is try and help people shape their cases if they're a bit complex. A bit of a scenario here, we do things like help someone's got a business on the side of their land. We'll help try and shape the deal so that you can title split potentially. We'll look at whether the land is locked in, which may be a cause of problem where we can't lend, but we may look to see if there's separate access from a side gate. Look at title splitting potentially with a legal team so that we can then lend on the main residence and ignore the limited company or holiday let section from the security. So we're quite happy to discuss this within the team, take on board any plans provided, and see what we can do to help shape it round to help lend. It's not just a straight no with ourselves, and we're quite happy to discuss by phone, by email, any queries like this, and see if we can help at all in doing that. Moving on, exception lending, something we're trying to progress on a little bit more. A few categories that we're currently doing at the moment. It's not something that we're 100% on every single case we'll take, but we like to look outside the box again and take a pragmatic approach and see if it's something we can lend on for the future. First category you can see there is 100% flat roofs, or it could be just from our lending criteria we do from 45% to 100%. We'll look at the location, we'll look at the materials used on the roof to ensure they're adequately good for the future. Most roof materials we accept. The only ones we don't really like is metal roofing. Bar that, we'll pretty much look at all types of style of roof materials used on flat roofs. Main thing we're looking for is if there's any, it's been renewed recently, it's been well maintained, and potentially there's any guarantees issued when the roof was replaced or when it was installed initially. Second category, eco-style properties. We're trying to bring ourselves into the future by looking at lending these styles of properties. Again, it's not something we'll 100% take, but we'll look on a case-by-case basis. These properties can be of all types of materials used. Again, the only one we'll probably shy away from is ones with metal roofing. We need to be seeing here that they're new build, that they've got an acceptable warranty from our approved list. They have good energy efficient ratings. We like to see ones with the solar panels, maybe wind turbines, something a little bit unique that's helping the planet. Main thing for me on these is whether they're saleable when it comes to valuation. So we're reliant on our valuers' eyes and ears to see if they're deemed acceptable in the market. So the only time we probably wouldn't really look to lend on these is if the valuer says that it's something that's not going to be readily saleable in the market within like a 12-month window, or due to the unique style, it's not something that everyone's going to want to look to buy. So good for us to get the opportunity to discuss with you. If you want to, again, get them into us, ring, chat through. If you can provide as much information over the types of materials used on the property, the wall materials, insulation, underground floor heating, anything, all the EPC ratings, as much information as you can get will help us make a decision to whether we can lend on these types of properties. Category 3 exceptions that we do is this is one that's probably not, again, the lender's not really in there for looking at these types of properties, but grade 1 and grade 2 star listed properties. The unique problems we get with these is obviously maintaining them for the future with the cost of materials, high insurance levels for getting them insured properly. And again, some people are obviously not looking to buy these types of property due to the saleability concerns in the future. We're quite happy to look at these as long as the property is not too unique and just a listed building that's pretty standard materials. We want insurance to be on standard terms. And again, we'll probably look for the valuer's eyes and ears here to see that the property is well maintained and there's not a dilapidation requirements or a lot of works to be done to complete on the property prior to us lending. This will counter out any risks for future maintenance and high costs if it comes to repairing any of the security. We've had quite a lot of people apply for grade 1 and grade 2 star listed, and it's been quite popular. I think it's quite good for us to keep our flexibility and look for these types of properties for the future as well. Final category on exception lending is ex-local authority flats. Again, we're open to areas of locations. We'd like to see prime locations, good saleability. Again, we're looking for good value properties. One area we won't look for of these if they're balcony access. That's a no from us for ex-local authority flats. Generally, though, we're quite happy to take a look at these. Standard leasehold, usual requirements with regards to service charges and lease terms, standard criteria for that. Bar that, we won't treat these any differently, and we're quite happy to take a look at these for the future. Couple of case studies that we've gone through. So obviously we spoke about eco homes, modern builds. So we're looking at striking modern design that's using more traditional materials. It could be timber and steel frame construction with tile cladding. We like a desirable rural location, designed by an architect. Potentially this one had a 10-year build zone warranty. We have quite an extensive list of warranties we use. There's probably about 10 to 15 on there. So we've got a good range of warranties we accept. This one had owned solar panels. Again, owned solar panels are fine. We just need proof of ownership or a title showing there's no lease on there for the title solar panels itself. If they are leased out, we'd need a copy of the lease agreement up front to ensure it's fully compliant. Property was nearly complete, but not habitable. If it's not habitable, we can move on with a full retention and complete a re-inspection on completion of the property. So we could treat this like a new build where we work off plan and then we'll re-look at valuing it prior to once it's all complete. This one had an excellent EPC rating, A to C. Obviously, this one's quite a high value at 2.75 million, but value is not really driving it for what we'll lend on. It's more the overall package completely. We are looking to expand our vision, embracing the modern build construction. We know a lot of other lenders won't accept this, so it's something we'll look at on a case-by-case basis. And again, we're quite happy to discuss this through. Case study on a flat roof. So we had a 1930s Art Deco style house, standard construction. This one was on a coastal location near to Brighton with sea views. Had a large garden, outdoor terrace, swimming pool, None of these really concern us. Good quality felt roof material with long guarantees. Modernly decorated throughout, retaining original property features. This is the sort of thing we're looking for. We don't want a property that's kind of run down and requires a lot of maintenance. Roof materials are acceptable. Again, we'll lose our pragmatic approach to the location, the build. When it comes to flat roofing, though, the build houses normally are of standard construction. It's not really something we want to look at. That's non-standard construction material property. Another case study for Grade 2 star listed. This was a highly desirable area of South East. Market value of property exceeds the average property price in the area. It was in exceptional condition with no adverse comments, findings when the valuation was completed. Valuer also deemed it with good saleability. This was a unique character property. Indoor swimming pool, standard build, standard materials used. When we look at this, we don't see this as high risk and deemed acceptable to lend on. Had standard buildings insurance with no loadings and premiums. Another thing we're looking for on these. But this type of period properties is known. There's quite a few Grade 2 star listed around, so this is one probably good for a sales point if you're looking to get these on get a mortgage lent across these parts of properties. This one came to us from the industry where no one else would lend. The client was struggling to get a mortgage, but was looking to look after some of his family and couldn't get a mortgage at all. Email came in to us and asked if we'd look at it at all. We again had a call with the advisor, long discussions. It was a historic timber frame construction with single skin walls. No other lender would assist with the loan. He was just looking to adapt his house to look after elderly relatives. Loan amount wasn't too high against the loan to value. Property was unique and was deemed to sell on the open market without any concerns by the valuer. So we took an approach again, took it to our funders, asked if there's any specific loan amount we could look to do between myself and the funders in a pricing view, and came up with a proposition that the client could then build their extension they required to look after the family members. And we took the loan on, minimal risk for ourselves, very happy client, and that we could help out and assist with their future living and looking after family members. So this is the type of thing we look to do, help to be treating our customers fairly as much as we can within our criteria. So what we want to improve with our service we offer, so we can provide the best support for the clients in retirement. Your feedback helps us achieve this. If you want to let us know of any questions in the box that we can deliver a better underwriting service, what can be done to improve, any areas that you think that we could look to lend on, which we've not gone across at the moment, that you think would benefit yourselves. Anything really, anything you think that the team does well, would be nice to hear some feedback as well. But also on the flip side, I'd like to know where we can improve. So as much appreciated as possible for that.
That's brilliant. Thanks, Paul. That's great. Thanks, Paul. Hopefully that's give everyone a good understanding of how flexible we can be at Canada Life. And as I said, obviously, please ask any questions. And we've got probably about 10 minutes now to go through any questions, or you can pick up with us individually as well. So I'll just ask a couple that's come through, Paul, if that's okay.
Sure.
We might have to pick this one up separately, just depending on the individual property, but just if you've got a view on it. So Ian Batchelor at Robinson & Co, thank you, is just asking, would you consider a rural property? It's end of terrace row of cottages, which has its electricity supplied overhead where the wooden pole is in the garden.
Yes, so potentially we were never concerned with lending on that at all. The only thing we'd look for is whether the correct easements are in the title for access arrangements and maintenance arrangements going forward. So although I can't 100% agree, majority of these do have them in place, and our legal team, solicitors, would be able to check that over. In fact, we could actually, if you wanted to email that in, we could actually check that with them pre-application to ensure that it's got enough coverage for us to be able to lend. So if you can get a copy of the title document from the Land Registry and pop that on an email, then I'm more than welcome to pop that across and we'll get that looked at for you. But in 100%, we could probably look at that property for you.
Brilliant. So if you can send that over, Ian, to, well, either myself, Lyndsey Charnock, or hf-underwriting@canadalife.co.uk, and we'll have a look into that for you this afternoon. Another one from Lee Stone. So I think we know the answer. Will you consider cob and thatch?
Okay, so at present, we're not looking at cob and thatch properties. However, it's on my radar, and we are looking to potentially look at this probably in Q1 next year. A few things I need to go over internally, but yes, I'd like to add this in if I could, and it hopefully will be in Q1 next year.
Brilliant. Another one from Roy Bourne. So will you consider holiday homes in the future?
We have had a product in the past for second homes. In the current market as it is at the moment, this is probably one that we're not going to bring back in just as yet, but there is scope for us to bring that back in the near future, definitely.
Yeah, it is under consideration. So one on the list. We'll keep you updated, Roy, as soon as we hear anything more. Thank you. And then we've got Vicky. Are you able to lend on a property where there is no lodger in an annex? There is a separate entrance to the annex. However, there is a door that links the annex and the main property.
Okay, so internal doorways is the only thing that we suffer with annexes that will have to be blocked up prior to the application or prior to valuation if you want to get an application in, but it needs to be fully blocked up with an external access into the annex. And then we'll treat the annex as normal, where we'll exclude the value from it, but still take a charge over the whole security.
Yeah, that makes sense. Kevin Hull, thank you. So could you clarify Airbnb? Can it be an internal annex with own front access, not shared?
So Airbnb can be used in the main dwelling for any bedrooms in there, for instance, but it can't have any locks on doors. And they must have free access to the house, but we do allow Airbnb on the main house itself.
Brilliant, thank you. Finley Waller, so if a title split is being carried out, can this be finalised at completion, or must this be done prior to application?
If we've had the adequate information put through and we've had a case assessment with ourselves to make sure we feel it fits for our lending purposes, and draft plans have been supplied, and we can see that there's clearly access for splitting the land, it's not landlocked, then yes, we will allow that to happen simultaneously on completion.
Brilliant. Chris Fisk, so this one is, are you still in the market for age-restricted properties?
Yes, it's one thing that we do feel strongly about, being in equity release, and we do still allow age-restricted properties, and we're very flexible over the age restrictions. Can be anything from 55 up to 65, subject to the valuer having no concerns over future saleability. We also will do sheltered accommodation properties with the age restrictions. However, we will reduce our lending by 5% for these, just to counteract any risks that are involved with the types that they are.
Yeah,
any clauses. Oh, sorry, Lyndsey, go on.
I was just going to say Lee's asking similar, so he's just saying age restricted ownership over 60s only.
So again, this wouldn't be a problem as long as the valuer doesn't see the location and the type of age restricted property being any saleability concerns for the future. We're pretty good with these. It's mainly the problem we see over the saleback clauses being more than 1% and service charges being over our 1.5 limit. Yeah. Bar that, we're pretty good with these, to be honest with you. So yeah, we know not thinking about pulling this out of the market at all. And we're going to stay in our position, being strong with that going forward.
Brilliant. And then another one, what sort of things will underwriting be aware of and make the decision on regards to postcode scoring?
Okay, so as you probably well know, our postcode profiling is built into our KFI generator. It's built in as a guideline, really. The team know exactly how the Acorn score works, and it is available for anyone to view on the website if you want to Google it. It's not something we pay for. It's a guideline of social profiling and property location profiling system that helps guidelines for us to look when we're underwriting. If it's past the KFI, then we simply use the Acorn scoring later on to help us make decisions on the exception lending, where we could look at the high-end quality properties. So the scoring is really used as an assessment tool for the team that gives them a better view overall of where we can look to help lend.
Brilliant, thank you. This next one, I think it's quite open, really, depending on the property and the location. So how close to commercial can a property be? Obviously depends on a case-by-case basis.
Yes, it's case by case. I mean, if we don't mind. Depends on the level of commercial surrounding. If it's small shop next door to a house, and it's not really like a noise-related food outlet, we're more than likely we'd take that on. If it's surrounded by an industrial estate and it literally backs onto the house, then that's something we probably wouldn't look to lend on. There's lots of different styles of commercial out there, and again, we like to take the pragmatic approach and look at each one on a case-by-case basis and make a feel whether we think that's going to be a concern going forward for sale. Me personally, I think most properties will sell in the market these days, so I don't see commercial elements being that much of an issue. Just depends on the style and the size of it that's nearby. The only one we probably struggle with is where we have public houses next door or backing onto the security. These ones we tend to only really look at if it's in a rural location, small village, and it's a bit quieter. So they're probably the ones we want to steer clear on in the normal residential locations, but will more likely take on in a rural location.
Yeah, that makes sense. Thank you. And then Alan from Equity Release Supermarket. So estate charges on newer properties, pretty sure you are okay with external management companies running the communal areas. Are there any obstacles we should look out for?
Okay, so estate charges on new developments. More for us, we're kind of looking at how much it is that's being charged for it. A lot of people like to buy their houses with large estate charges attached to it. Obviously, these sort of things comes more for flats. Again, with eyes and ears with this is with our valuer to see whether that's deemed an issue going forward for sale. The only thing I'll probably look for is whether they're escalating each year to whether they increase at a high level, or if it's just done on inflation purposes, which will probably be fine. If it's going up every 5 to 10 years and doubling, then this is something you need to probably avoid, and it's not something we'd probably take on.
Thank you. Stephen from Responsible. So this one might need sending in and we'll have a look at individually. It's an oak framed house, not double brick between oak, built in the late 90s, no BI uplift, desirable area, 1 million plus.
Okay, so this is probably one, yes, we'd need the full details, and we may actually look at lending that on an exception basis.
Yeah.
If you can provide as much as possible and pop it into our underwriting team, we'll quite happily take a look at that and see if we can do something for you on it.
Brilliant. If you send them details across, Steve, that's much appreciated, and we'll get back to you later on. And then the other one is just regarding the acreage. I think we had this on the lending criteria clinic the other day, because it seems pretty standard with we'll only value up to 5 acres. Is there any particular reason why we keep to 5 acres?
It's just really for the high level of acreage. Again, it's not everyone's cup of tea when it comes to buying a property with large amounts of land. upkeep on 150 acres could be quite a lot for some of the elderly people or lay people. We kind of cut it down on our risk for future saleability by only valuing up to the 5. However, again, this is something I've been looking into, and we are potentially looking at taking on the whole lot in the near future, just to make us again more flexible. Not sure whether we can get that in Q1, but doing some MI and some background info on that to see if I can push it through. But yeah, the real reason is just future sale and upkeep for the amounts of land that you've got on there. If we had to take possession of a security, it'd be a lot easier, excluding the large elements of land and just selling the house value up to that level.
Yeah, that makes sense. Just one more. We've got one from Rachel. On a freehold house, would you ask for a deed of variation for a rent charge with monthly service charges for the usual things on a new estate?
Yes, we would. I think there'd have to be a deed of variation put in onto that. Again, it's probably one that we'd have to put for our legal team to check it out on the title and see what's on there. But yeah, in general, I think we'd probably have to ask for a deed of variation for that to be removed.
Brilliant. Thank you. Okay, well, thanks, everyone. Hopefully you found that helpful. And as I said, any further questions, any cases that you want to run by us, just please either pick up the phone to myself, or you can pick up the phone to your key account manager. So we've got Kieran Mullen in the north, we have Julia Lockwood in the Midlands and Southwest, and we have Trevor Hansen in the Southeast. You can also speak to the sales team, the telephone account manager team, if you email into retirement-sales@canadalife.co.uk, and obviously the underwriting team as well will be more than happy to help. But thanks for your time, much appreciated. And as I said, we'll speak to you soon. Thanks very much.
Thank you, everyone.
Bye.
Bye.